back, guys. This is episode number 38 of the Slap the Ask show. We got our good friend coming back on for his second time on the podcast, Silly Sheep on Twitter. Welcome back to the show.
Thank you very much. Thank you for having me back.
Yeah, of course.
Thanks, Silly, for coming back on. Our first recurring guest, I believe, if I am correct, Luke.
Yeah, we went on Penny's podcast, but the first one on twice for our show.
Yeah,
I feel very honored now.
You're in an elite club.
Awesome.
One-on-one.
Well, I hope you do you proud. So
Yeah, for sure.
Awesome. Well, Sheep, thanks for coming back on the show. We haven't released an episode in quite some time now, but in the last few months, the market has been very shaky, whether it's OTC or NASDAQ or just big boards in general. It's been hard to find any green in this sea of red.
you're absolutely correct. It has been vicious.
It's the first bear market I've ever seen in my lifetime that I've been old enough to trade. But as someone who's a bit more experienced, I guess, what are your thoughts on what's going on right now with this bear?
This is definitely probably the worst bear market I've seen the market go through since I've been trading as well. There'll be a lot of people out there that say the same thing right now because it's so you don't know what's coming. You just don't know with the way what's going on in our country and the globe and everything. All the big changes. It's like a metamorphosis that's happening in a sense with everything that's around us that affects the trading, affects the valuations, affects everything. And then, so when uncertainty hits the market, we all know what happens. It's, cash is king. So not only is retail having to get out and losing from what I've heard, billions and billions, possibly hundreds of billions or trillion. I mean, it's amazing how much wealth has been lost on this bear market because of the way they've done it. And of course, the only people that made any money were the bears. So, and they're tearing it up bad. So,
kind of going off of that, Sheep, like for like all the less inexperienced traders, or like for me, for example, I started trading in like 2020 when the market was super hot.
right.
Do you think it's almost better not to trade and just watch for individual stocks? Or like how do you approach it, and how do you think a beginning trader should be approaching the market right now?
Well, if you're a beginner trader and you are only comfortable with riding the bull, then I would definitely put your cash in your pocket and hold on and wait.
Right.
Playing a bear is difficult because it can wipe you out so fast with the squeezes that go on, and it's amazing that they get them so short floated. And if you're not paying attention to all your DD when it comes to just the figures and the levels that the short activity is, then you're gonna get caught with your pants down, and next thing you know, you squeezed up 150% before the market even opened up, when you probably could have seen what was going on the day before and gotten out as a bear. And if you're not experienced enough to see the signs that are when it's coming, then I wouldn't play with it. I'd stick to waiting out the bull market, or go play ETFs on the commodities, because I mean they're always somewhat predictable in a sense. So
Yeah, it's funny that you say that, Sheep. And I think one thing that I've noticed so far in the bear, compared to the previous bull, is it seems like the bull is generally pretty stable. It's just like chugging along nicely, whereas the bear, the movements are so violent in either direction.
absolutely,
It does go up a lot. Those bounces are pretty aggressive as well.
absolutely.
So I think, like you said, something like an experienced trader playing that volatility is actually a great opportunity to make a lot of cash.
Yes, it is. And not necessarily playing on the bear side. You're not shorting stocks either. There's so many opportunities out there to catch the squeezes on the bears that are coming along right now. Because in a sense, if you stop and think about it, we've been in a bear market a good while. I am not by any means saying that it's over. All right, I'm not at all saying that it's over. But what I do understand about the market is that it goes through cycles, and you can't just always sell. It just doesn't happen. You run out of shares. And when you run out of shares to sell, then the only thing left to do for a bear is to cover. So once the cover starts and they start reaching stop loss levels, it becomes automatic until all the shares are cleared. Unless you're having a problem with failure to delivers from your the house, which a lot of stocks have been having issues with that too. Failure to delivers are like killing a lot of the plays that are out there right now on the squeezes, because they just can't satisfy the orders. But if you if you watch for certain signs right now, you can see them exhausting out on the bearish side, and the indicators have ways of letting you know that ahead of time, and you can take advantage of that. And now, of course, it's always a risk. You never know what's really going to happen, so it's always a risk. But you got to nut up sometimes and take that risk if you think it's there. It's the only way to really get ahead is take the risk. When it's the best. We've calculated all your odds, the best odds you could possibly gather, following all your indicators and knowing what's going on with the numbers with the stock. That's important as well. You have to know what's going on with the float situation with it. And if you can tie the 2-3 things together, it doesn't take as many indicators to figure out a squeeze is coming as it does to figure out where I think a stock would be going, if that makes sense.
Right.
I use 4 indicators looking for a 3 out of 4 indication to give me ideas, to be looking for a bull move or a bear move or whatever the case may be. But with a squeeze, you don't really need too much except knowing where the float is sitting and then looking at I use the price channels. I like to use price channel squeezes to indicate that a squeeze is coming. And a great example of that has been what's happened to Carvana this week. They've absolutely gotten the blister squeezed out of them, man. It's been fun to watch. I wrote it some too, so I mean, I know they're out there and they can be made if you just watch what's going on. And I want to share some of what I know about these price channel squeezes because they work. I called Carvana. I told y'all in the chat room, the other afternoon, I was like, I am in here at 4:43. Is getting ready to squeeze. And what happened the next day? We were set up at 560 something. And then the next day today, which is today, only 2 days later, it tapped 8.25. So, and I was looking at 850 plus as my tweet said on Twitter. And the reason being is because that, your resistance levels are right around that area for the first stop. So,
yeah, it was
So,
a great.
yeah, Sheep, one question I have. So, first of all, for like people who don't know, like what is a price channel squeeze? And then also, you're saying you identify these squeeze plays. How many stocks are you typically looking at to identify them, or are you just checking the news and seeing what's happening, and then you're putting the indicators into place on them?
you don't know me long enough to know that I don't look at the damn news. I should be.
Right, yeah. I figured I knew that answer. All technical, right?
Yeah,
For the
exactly.
viewers, for the viewers.
You show me a chart and I'll tell you what I think. That's all I can tell you. I mean, I've heard rumors that Carvana is like on the edge of death, and I don't know if that's true or not. I have no idea, and I don't really care. All I know is that when I looked on the website and I found out their figures as to where their floats were and everything, and I saw the chart, I was like, holy mackerel, that's going to be a good one. It's going to be a good one.
Yeah.
And,
it's definitely squeezed up. I think Bed Bath & Beyond is another one that's recently squeezed up as well.
You're exactly correct. The same thing happened with Bed Bath & Beyond. And to be honest with you, I have not looked at that chart yet. I mean, I haven't, but I've watched it on my phone at work. And that thing was up, what 210% yesterday or something? It was craziness. Matter of fact, after we get through talking about Carvana, I'm probably going to pull up that BBBY while we're talking about it and take a peek at it. So, but if you want to, I sent you those pictures of the charts.
Yeah, you want to pull up the Carvana chart first?
Yeah, let's pull up the 4-hour Carvana chart first.
All right, let me know if you guys can see this or not.
Yep, we can see it.
Yep. So let me get mine up on my computer here in front of my face, and we can talk. All right, so on the 4-hour chart, if you look, you're I don't know about 7, what is that, 8-10 candles back or so, right above the between the Tuesday and the Wednesday. Okay, you notice that the price channel on the outside, which is your Bollinger Bands, okay, that's going to be your pink and red. They started torquing inward. They started torquing inward hard, and then they crossed over my other price channel that I have up here, which is called a Keltner channel. Okay. And when that came across and you saw your Bollinger Band squeezing down tight and it crossed over that Keltner and the Keltner wasn't phased, that told me that it was potentially going to squeeze hard. Now, when I say that, you have to understand that that squeeze could have gone either direction. It could have shot this thing down to $1.75. You know what I mean? It's not so much that, it was definitely going to go up at this point by looking at this, but this is an indication of the squeeze is getting close to happening. What told me that this was going to be a bullish squeeze or a bear squeeze, so to speak, but move bullish on a bullish trend was that I looked on the website and this stock is over 80% short floated. I mean, think about that. It's 80% on a short float right now. I mean, you got to cover. It's just like at that point, it's about torqued out.
Yeah.
So knowing that number and then seeing this price channel squeeze right here where the Bollinger Band squeezed to within the Keltner channel, it told me, I mean, I got goosebumps, to be honest with you. I was like, this is going to be a monster. And I bought. That's what I bought right then and there. I didn't ask questions. I just went ahead and bought, put me a nice little safe stop loss on it so that if it did happen to be the other direction, I get punched out with not too bad of a loss. And then I woke up the next morning to heaven. I mean, it just started taking off. We went to that first little shelf right there up around 560, 570. Right. So that day I took like $1.20 off my money. So, off a $4.43 investment.
And I mean, for people who are watching, like if something's over 20% short interest, that's considered high, right? So 80% is like astronomical.
It's just subject to a squeeze between about 18% to 20%. You're absolutely correct.
Right.
So when you see one that's 80%, I mean, come on, that's like a no-brainer in my opinion. I mean, and this is a great lesson to learn for new traders, because it's not just about, the indications on the chart showing you that the squeeze is about to take place. You got to determine which way the squeeze is going to go. And if I looked at the numbers and I saw that it was a 1.5% short float, I wouldn't have touched it. I wouldn't have touched it. But knowing that it was an 80.5 or whatever it was I saw, I was like, oh my God, these things are about to cover hard. And sure enough, bam, that's what happened. The squeeze happened. Notice on the first shelf there, about the 560 range, it couldn't even really dip back down in between. It went straight across and then launched again. That's because, the squeeze is the squeeze. And when it went back into real-time action, the stop losses started getting hit again. And bam, 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 bam. Three more candles. And it looks like it's about exhausted. If you look at that red line on the top there, when I bought the other day, that's where I marked my resistance. And you see where it's sitting, right about a little over 850. That's why I had on my chart 850 or plus. Well, it went to, what is that candle right there? Let me look. The high was 836. I missed it by 14 pennies.
Wow. So you exited at like 820, something like that.
No, I exited earlier than this. I didn't stay through the whole ride, but I did.
Say, that'd be pretty impressive.
Yeah. I mean, nobody's perfect when they call that. The bottom line is, don't ever forget that a green trade is a green trade, no matter what. So, and I made plenty enough money. I did very well on this stock. But I didn't catch that last little shot up to the 8 mark. I just was saying, I believe it's still going to go up more. And sure enough, that it did. I mean, like I said, I missed it by 16 pennies or something. So, and to call that off of $4.43 to, get that close to 850, I missed about 14 pennies. So, I'm not bragging about it. That's not what I'm getting at. I'm just saying that this is the kind of information that you can create for yourself by paying attention to not only the indicators right now with these bears coming to whether it be an exhaustion point permanently or whether it be an exhaustion point for a little slight adjustment and then thump down again. I don't know. All I know is that I am seeing across the market several of these setups right here. A lot of the low float micros, they're setting up on a regular basis, bouncing off that bottom and making serious squeezes, 100%, 70%, 60, 40%, whatever. They're getting squeezed left and right now because you can only sell off shares for so long, and then all of a sudden you got to cover them. And they're automatic. And once the first stop loss gets hit, if it's bigger than the amount of shares that's on the ask right there to buy, it goes to the next number on the ask up, and it keeps going up until it finds all its shares. It will not stop. It's computerized and automatic, and it goes ballistic, just like this one right here did. Went ballistic. People kept trying to short it right there at the between 5 a.m. and 9 a.m. this morning, they started trying to short it, and I mean they couldn't get it to go down below the freaking Keltner channel line. I mean, the Bollinger Band's wide open. It's riding the Bollinger Band beautifully, and then it couldn't even get back to the Keltner. And usually the Keltner is like the ground for it. You know what I mean? It'll bounce more on the Keltner in most cases when it's a squeeze situation. But this thing's outside of everything. Went way on up there, and I'm impressed with the way it moved. And there's other ones out there that are set up just like this. They're all. This is the time to be looking for these setups right now. If you want to make some money on the market, it's risky. Don't ever think I didn't say it wasn't risky. I know this, but it's something that if you watch it and mock it, and watch several of them take off from this position in the charting, and if you can find one and you just tell yourself that thing looks like it's going to explode, just wait and see if it's going to explode. If you do that 3 or 4 times on them, maybe think about putting a little money on it and see if you can capitalize with it. Just get yourself in a feel for it, because that's all I did. I just noticed that the indicators were telling me that it was going to go volatile some direction. And then I looked at the float and saw it was an 80.5 short float, and I knew exactly what direction it was going to go. So
Yeah,
So,
it's crazy to like. Go ahead, Jimmy.
I was going to say, like, Sheep, in this fair market world right now, where you're looking at a lot of data, particularly what the short interest is on a stock, do you feel like it is better for you to be more on the big boards and less on the OTC? Because the OTC does have a little, funky with the reporting of what short interest is and things like that.
well, I'm an OTC player from way back, and I'll know the tricks of yesterday are not always going to be the tricks of today now when it comes to trading those things. We all know that there's a bunch of shysters on that market. We all know there's a bunch of line SOB CEOs that, they have a setup where all they're doing is just diluting and reverse splitting and then raising ASs and diluting and reverse splitting and raising AS. It's just a constant thing. And those are the ones you just need to avoid. All those mega ASs that are out there, I see, 50, 70 billion shares or 100 billion shares and things. What's the point of even trying to expect one of those things to come off the bottom? I would never do it. One of those, I would wait till they had a massive reverse split, let it race on back down after everybody sells off after the reverse split, and I'd be waiting for a squeeze, So, I mean, that's the only way I would play something with those big. I would not do it when they're fat. And I've got a couple good stocks that I'm in right now in the trips that I believe could potentially move 1,000 to 1,500% easily because they have a very small AS, very small OS, no dilution what to speak of hardly in the last year or so. They're no toxic debt in one of them by any means. Matter of fact, the CEO holds all the notes of the money that he loaned his own company. And those are the ones in the OTC that I'm looking at right now. I'm looking at the very bottom. I'm in the bottom of the pond in the scum right now, and as prices are concerned. And I'm trying to find the ones that have those real low OS AS setups and aren't toting toxic debt that's never going to let them get out of the bottom. And I've got a couple, 3 of them that I like. Of course, I'm still all about Venue. I think Venue is going to be going to shine. It's going to have its moment. We almost got our gap closed when it went to 30 yesterday.
Mm-hmm.
But the gap's not the gap. We still got to go down, in my opinion. I'm thinking we might see 27, 26 real quick before it turns around and gets on back up to the 50s again, 0050s. But it's got its day coming. I'm certain of it. Anybody who can sell a business to Mark Cuban he definitely know how to make money. So.
Right.
And then of course AXXA is still one of my favorite ones out there. I'm baffled. I'm just kind of really awestruck as to why this stock is still not cracked back over a penny and stayed way over it. Knowing what the valuation of that company is, I mean, they're hundreds of millions, I think, in assets and stuff, and I don't get why they don't see the valuation of the company, because I still evaluate it out at a minimum of 2.5 pennies right now, 3 pennies. And we're 1/3 of what it really should be priced, in my opinion, right? And could be even more than that if the news keeps coming in good, because the man's doing nothing but increasing sales, increasing revenues, increasing profits. Everything is increasing for them, and it's being ignored.
Do you think that's kind of just like an overall reflection of the market? Like even these penny stocks that are doing well as a company, they're just undervalued just because people are so negative with the market. I mean, it's kind of like Amazon in the early 2000s, right? Their P&L and everything was better than it ever was, but the stock was trading lower than it ever was, you know?
Right, and I'm not. I would have to look back and see what the rest of the world situation was when that was going on to kind of be able to fully wrap my head around it. But right now, in my opinion, most of the money is working. There's people who think just like me, like good traders that think just like me. And again, remember, 90% of all trading that was going on is institutional anyway. So with 10% retail only out there, they're not really making too big of an influence. It's about chasing the institutional money all the time. So
Right.
if you know you got an institutional investment going on or an institutional dump going on, you just have to, you got to coattail it and go. That's all there is to it. But
Yeah,
with
I think you kind of recognize that with Carvana, right? Because if you look at the short interest over the life of the stock, like, I mean, the thing's been plummeting since the spring of last year. It was trading over 150. So, like,
yeah,
when you think
off of
about it,
one
you're like,
went down all the way to something. Isn't that
yeah,
crazy?
it's like you're like, of course people are shorting it, but then you're looking at the technical analysis on a day-to-day basis and trying to find the opportunities for the upward squeeze.
Right. I mean,
Yeah,
if you can't get in and trust the bear movement on it, and make money off of it, you got to wait until they've got to cover. That's the only thing there's that you can do. If it's not a bull market, you're not going to make money on the green side, on the bull side. You only can make money, in my opinion, with these squeezes that are going on right now. And it's about doing some mathematics. You really got to crunch numbers to see, what kind of volume has been coming in, what volume is going on when the squeeze happens. Because if you, I don't know if add Daniel, whatever, Daniel.
Yeah.
So I mean, well, Daniel and I have had several conversations about it, and basically, you've got to pay attention to all that's going on. The failure to delivers are big. If you're having a bunch of failures to deliver, then there's black dark market money messing around with it, and I don't want to get involved with those because they can continue to go down even after it says there's 0 shares left to borrow, and you're at borrowing rates 115%. It still will keep going down because there's dark money being dumped on top of it. And so I stay away from the ones that have serious problems with failures to deliver. And there's a lot of them right now. It's just the way things are. Unfortunately. Also, I try to stay away from the stocks that I see are out there that are getting that hit it and forget it right now. And that's the difference between investing in a stock due to your diligence and the fundamentals versus I'm out there to make a quick buck. And I feel like the mentality has shifted terribly to that I'm out there to make a quick buck in a lot of aspects. I mean, there's no reason why Venue should have come back down to 003. I'm sorry. They got it almost over a penny. It's come down below the 78.6. It's like it's being tortured, and it's all because the people bought the ride up and then they've been dumping it out, as much as they can on the way down. And nobody making money on the bear side of an OTC stock. I'm sorry. The only people that short them things are the MMs anyway. And that's just to
right.
get it back down in position to resell them. So in the end, it's just a hit it and forget it mentality. And Daniel and I were talking about that. It's like it's what it is right now. And in my opinion, to be honest with you, I think it's a lot of new traders, a lot of new money that's out there. They follow getting these chat rooms, where they pay them $50 a month or something to get their ear wrung out with some stupid information just so the other person can dump on them. And hopefully they'll be affected by the 90-90-90 rule, which we all know what that is.
Yep.
90% of all traders lose 90% of their money in the first 90 days. So, and get them out of the way. And I just want to see the market get back to a place where it can actually be traded properly again, as opposed to, this hit it and forget it crap that's tearing all the stocks up. So, and OTC, you asked me a question about the OTC, about it not being active. You got to understand where the money's being played right now. They're taking advantage of more of these squeeze plays because a lot of people are seeing this scenario where the bears are winding down because they're running out of shares to keep shorting. And the borrow rate's going up more and more in a lot of these stocks. Every single day they change to a higher rate, and the higher the rate gets, and also the premium. They get a premium, and if the premium goes to a negative for the payback they get, the premium money they get back from the shorting, If it goes into the negative, then that means they've got to cover that short every day. They can't hold it for longer than the trading day. And so you know that those stocks are going to end up covering at some point during the day as you trade. May not be a lot, but it still is what it is. And so when you start seeing all the available shares disappear out where there aren't any more shares to borrow, and you know that premium is in a negative, and you also know that the borrow rate's way up there, 50, 60, 80% or something to borrow the stock in the first place. Those short, anybody who tries to blister it down is going to turn it around and get covered like a snap of a finger. That's all there is to it. They can't stay on top of the short for very long. So those are all just numbers that you got to go digging into the stocks and finding out where they stand with all that information. And then you make your chart analysis according to where they're situated with all those figures, if that makes sense.
Yeah, definitely. Did we want to pull up another chart, Sheep, and take a look
Yes,
at
I
it?
do. I want to, first of all, if you want to throw that daily Carvana on real quick, I wanted you to look at that just so you could see where I drew that resistance and the reason why I drew that resistance, just so people can kind of understand why I draw my lines. If you look back around 1128 on that chart, you see where the line touches the tops of the candles right there.
Yeah.
That's going to be your first line of resistance to pass. And that's why I drew the line. And you can see where the green candle is according to the line. It's not quite there, but it looks like it's, in the zone. So, and that's why I draw these lines like I do. I'm trying to show where either you're going to find resistance at you first or you find support. You know what I mean? And you know what they say, if it's a bull, what was resistance will become support. If it's a bear, what was support becomes resistance. So right now we're looking for what, hopefully what becomes resistance becomes support. And we see this whole market turn around so we all can get back to making some money on a regular basis, without having to figure out these tricks. So, but this is a strong chart. The daily chart right now for Carvana is super strong. Look at that DMI. What a set of duck clips that is with his tongue hanging out. Holy mackerel.
Yeah, it is funny when you look at it. Like,
yeah, the ADX is dead solid, right where it wants to be, moving up, and it's like let's see what it says. It's a 23, roughly 2369, 2370. Well, when an ADX hits 24, that's when it starts really getting the interest, and so it needs to turn back up and come on up like it was when it was up there around 29, 28, 29, because that was priming everybody up. They're loading up right there for this move that's going on right now. Any retail that saw a bull opportunity like me. I got in it late because I didn't see the stock till late, but I saw it soon enough though. So I was very happy to find that thing at 440 something the other day. And I've kind of been watching it. It was kind of zoning right there for a few days. And then I just kept looking at that 80.5% short float on that thing and just couldn't resist. Finally bought 2 days ago. But anyway, all right. Next chart was the El Natural Gaso. One of my favorites, everybody knows.
I was gonna say, good old natural gas for Silly Sheep.
Yeah, natural gas, Sheep. I feel like it's been very weird the last few months. Not even just based on the chart, but just on what's going on in Europe, the U.S. Seems like it's a pretty warm winter time over there. I guess, can you give us some thoughts on the macro environment relating to natural gas, as well as what the chart's telling us?
Well, it's what really set it off in the first place, in my opinion, when it went up to the 9 to 975 range, and I think did it finally hit $10? I don't know. Look at this thing right here and see it.
I think maybe over the summer it almost hit it.
Yeah, but it hit $10 and almost $10.03. So basically, let's call it $10. I think that a lot of that had to do with the beginning of the inflation that we were having. Because the inflation, in my opinion, it was out of hand before people realized exactly what was going on. And there's still a lot of areas that are ridiculous, like food. Food costs are unreal. If you go and look at some of the futures for like live cattle and feed cattle and all that kind of stuff, they're still just going up, 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 up. I mean, you go to the grocery store and see what it costs to buy a ribeye steak, and you can tell that,
Yeah,
So
it's not cheap.
I think that was the first thing that set this off because if the cost of gas goes up, when it costs more money to pump it out of the ground, and when the value of the dollar goes down, which we saw the value of the dollar go down tremendously, and a lot of times when this thing was spiking up. So there's several catalysts that sort of drove this thing to the roof in the first place. But um, what I know about natural gas is what goes up must come down, and that's pretty much what's happened here in this picture. This is their weekly candles, and you see the weekly candle. I have that zigzag drawn on it because I made a chart back in September, and I called this move, but it ended up being even more bearish than I thought it was going to end up staying. With a long-term bullish move because of the way the inflation was going. I really thought that inflation was going to go much faster than it's going now. It's got a break right now, but I don't think it's over. I think things are going to get a little worse when it comes to how much it costs you to eat, mainly. But this thing ended up being a little more bearish, and what it did, it just stayed true to form and wanted the 200. That's what it really looks like to me. So that blue line on the bottom down there is the 200 SMA, the simple moving average for the weekly candles. And it came down and found it, and it's been hovering on it now for almost 2 weeks, back and forth. So, in my opinion, we might see either what's going to be, let's see, A, B, C. It's going to be either leg D on a bearish move, where at that point it should come, in my opinion, roughly back up to maybe as high as, I don't know, six and a quarter. If it gets some steam, anywhere between 575 and 6.25 would be my opinion about it. If it doesn't, then we might see this thing going down below $3 and start hovering between $3 and $4 up underneath the 200 here, and find the 200 as resistance for a while. It really just depends on what goes on with the economy and everything right now. This is very driven by the economy. People don't realize this. It's a lot like oil. It's a lot like gold. Gold, whenever the economy looks like it's doom and gloom, gold goes through the roof because everybody's, that's where they think their money's safe with it. Well, natural gas, remember, it's not a stock. It is a hedging instrument for the underlying market of natural gas. So when you have inflation of the natural gas on the underlying market, the price, it'll drive its price up, and it drives the futures up with it. And then all of a sudden, all your gas producers and everybody, they hedge, they short it. And so that's why we see the violent reds going down on the chart, is that's them taking advantage of the fact that they've shorted the stock, and all they got to do is start tapping stop losses every morning at a specific time. They probably say, oh, look, there's a pile of stop losses right there. Let's go thump it. And they'll shoot it down real fast and hit it, and they cross their fingers, it sets off the chain reaction, which you see it does on many of these weeks. It was set off pretty hard. But there we are. We're back to the 200 on the weekly chart. And in my opinion, it's something to keep your eyes on, because you could possibly get a good play out of it, returning back up to 575 to $6 on this thing. But again, always, use the prudency of risk management. You've got to make sure you protect yourself, especially when you use leveraged money, which is, we all know that these commodities, the futures, are leveraged money, which means you're playing with somebody else's money when you play. You pay $5-6 grand for a contract, you're actually slinging $60,000-$80,000 in natural gas. So if you lose on $80,000 of natural gas, not on $5,000 or $6,000 loss. Okay.
Yeah, it's kind of crazy when you look at the chart, because you see the red candles and it's always drives it down, then it shoots back up. But I guess you're saying the risk is that these market makers, every time you think it's going to bounce up off the resistance, they just drive it down even more.
Exactly, because I mean, you got to stop and think about it. If they can turn the underlying market upward and move it up while they're still pushing the future down, they get what you've heard me talk about, spreads. They get a wider spread between the two prices, and then how do they make their money? They turn around the other direction on the futures, and they capture the spread, go back up to the price of the national underlying market, and they made not only the money of the underlying market going up, but they brought the futures back up after they turned and covered their shorts and went along. So, they got to make their money to pay payroll for all the stuff that they do, because it's not cheap to pump gas or oil out of the ground or process it or any of that stuff. It's not cheap. And so they definitely, utilize this to make sure they make payroll every week or every month. But it's still, again, a game that this is, 5 to 7% probably retail that trade natural gas. The rest of it are institutional traders. They are groups, out there slinging a bunch of people's money at one time. So you see those guys. I spent years watching those guys swap hands. They'd stop at a certain level, and I'd literally watch the trade go back and forth, and they were swapping contracts back and forth. And then when they finally satisfied each other on the swap, one guy was done going one direction, and the other guy was ready to take off from there, go to the next direction. So it's a game they play, and they've got it down to a science, which really, in the end, if retail ever tries to figure it out, they think too deeply about what the process is with all this of trading of these commodities. That's what confuses them and makes them lose all their money, because they start, asking questions, this, that, and the other. When if you could see the price of what's going on in the underlying market, you got a much better advantage to trade the futures at the same time, if that makes sense. If you can see the price of what's going on at Henry Hub, you can pretty much see what's going to happen with these futures, because they trade in a certain zone. They always have traded in a specific zone, X amount of pennies movement on a percentage of the valuation of the candle. So, and that's all stuff that I really don't want to get into it, because that gets complicated for people to understand, but there's a method to their madness.
Yeah, so you're more or less just trying to recognize the patterns that they implement.
Right, exactly. And if you look at the chart that's up there right now, what a beautiful slanted head and shoulders.
Yeah.
I mean, for real, it's a beautiful head and shoulders. It's just slanted bearish, because we have been in a bearish market above in the stock market, ever since those candles started making their peaks. I've seen a market profile printed a few times through natural gas that had this exact same pattern, but it was situated like I had drawn on my chart in September, where it was more of a bullish. The 200 weekly had kept grinding upward, and that same head and shoulders was made on top of the 200 and was more of a bullish move, because the bottom, where we at right now at the bottom, is lower than where we were back, say, hold on a second, let me pull it back up. Oh, come on. So if you look at it, your bottom over here at 1213, let's see, in 2021, you'll see right there, November, December, that area, when it found the bottom right there. Well, that bottom is higher than the bottom it just hit when it came down to the 200 now. All right, so it's definitely dead. The bear is done, in my opinion. But if we don't see it get some traction right now, it's going to come down deeper, and I believe it's going to beat up the underside of the 200, making it the 200 resistance. I played on this thing when it's down there at $1.50 and $1.45, 48, and that really was one of my. I made some money down there, because when it came up out of the bottom over $2 that last time, it kept going and kept going and kept going and kept going, and like we got to play 290 something before it finally decided to call it quits. I think it was like,
would you enter in again if it went under $2, or they depend on other factors?
Well, to be totally honest with you, I'm entertained to look at some contracts right now because of where it's situated on that 200 for the weekly candles. If you look and see the bottom line that's on that chart, the light blue that's squiggly along the very bottom, that's your open interest, okay? And it's showing you what's going on with the contracts right now. So they're selling out, they're dumping out the contracts right now still. And if that price does not move as that open interest makes it to the bottom, all the way to the bottom, the price range still stays pretty much straight across, then it in my opinion, we might get that turnaround I was talking about and head back up to 575. That might be the next run for them to hedge at. So
yeah, I feel like if you just look at it historically, it seems to be the case. Like whenever it goes below $2, it seems like it doesn't stay down there for very long. At least over the last few years.
It really doesn't. It stayed let's see if I can't get it. over in that area, this chart here. Yeah, so okay, it came out, and when it finally stopped coming from off the bottom, it actually, the first time it stopped, it resisted the 200. Like I'm thinking this might end up doing now if it doesn't turn and make its move. It resisted at $2.68, $2.70, roughly 274.3 was the high, and that's, I mean, that's coming off of 177. Okay, that's a big move, you know, for continuous green candle after green candle, percentage wise. If you had the contract that was going on right in that area, you made a lot of money. Even that little move right there from $1.75 up to 274. I mean, you stop and think about your percentages on that. And it all was pretty much, most of it was within one contract, except for two candles, it looks like. And you tore them a new one. But then, you know, it came down again and it tested the 179 area again, 180, and then it took off, you know, the rest of the way, went all the way back up to $3.42, $3.43 or whatever, 339 looks like. And so, you know, once it got that momentum going, that's when I think the inflation started kicking in, to be honest with you. That's when it brought it off the $2 mark and started doing its moves, and it never came down really below 250 to 240 again. I think the inflation started to kick in right then, and then we saw what happened from there. I mean, the valuation of natural gas continued to go up, food started going up, blah blah blah. It all just started taking place. So, and again, when you have inflation, what does it do? It drives down the value of the dollar. So if the dollar went down a dime in value, that sets off a parabolic move for natural gas because it takes more money to buy the same amount of natural gas. Does that make sense?
Yep. Mm-hmm.
So it automatically is going to drive your price up. No two ways about it. So, and then of course, you know, when we got over here right there when 2022 was almost coming in at that one little bottom shot there, that all that move from say 375 area all the way up to the $10 mark where it went to, that's all inflationary driven, I think, in my opinion. Just the dollar sucked. That's all I can tell you. When the government wants to get out there and keep printing money over and over and over and over and hand it out over and over and over and over, you can't expect the money to be worth anything anymore. You know, every printing makes it worth less money. So
Sheep, in like a world where the macros affect, because I know you said in stocks, you don't even care about the news. Just follow what's going on the chart. Natural gas, you just said, you know, the money printing and things like that the government's actually doing is affecting the price of natural gas. Do you implement the macros in your trading strategy, or do you still follow the technicals?
Natural gas is really the only instrument that I would trade that I care fully about the fundamentals, because you've got to know about your storage, you've got to know about your rig count, you've got to know, you know, you got to know what's going on and what's driving this thing. But the most important thing is you got to know what's going on in the underlying market. That's most important.
Yeah.
If you pay attention to the underlying market and you see what the action is between both of them at the same time, the underlying market and the futures, you're going to understand what I'm getting at when you'll see when it's time for them to make a spread, because they're done going upwards with the underlying market for a little bit, and they want to hedge their stuff out and let it drop, bring the price of the future back down again until they can get it to a level to release the hedge and turn the other direction on the bull and ride both the price of the underlying market and the future back up again. So they made their money one time up, turned around, went back down, made their money back up again on two separate markets, you know? So it's nothing but a hedging instrument. It's all there is to it. And they're capturing their profits on the underlying market move by hedging them on the futures. And so what do you want them to do? As soon as they hedge, the first thing they want to have happen is the price go back down. You know, they could drive the price of the underlying market back down on purpose, which drops the price of the future back down, but they're not losing a dime because they've got it hedged over on the future. You see what I'm saying?
Yeah.
It's a racket.
Yo, Sheep. So I know we're probably about time to wrap it up soon, but just one last question. So with regards to natural gas, right, there's a few things you identified you can kind of notice over time to trade more or less successfully. Do you think you can apply those principles to any commodity, or is it only
No,
more so
actually,
than-
several commodities you can apply that to.
yeah.
Any real consumable commodity that's out there, they're probably being utilized the exact same way that the natural gas futures are being used. They're a hedging instrument. They're not a stock.
But for a
Um,
retail trader, I guess you only have so much time to notice the macro trends and what's going on with probably a couple of them, right? Like you choose to focus on natural gas because you're following it. But if you switched over to something else, you probably wouldn't be nearly as informed, right?
Yes, you're correct because you know that I don't do fundamental research when it comes to my trading with stocks. Barely. I mean, I know what's going on with Venue. I mean, I've done the research in that. I know what's going on in it. I know what's going on in AXXA. I've been playing AXXA for 3 or 4 years. So I mean,
Mhm.
it's like I'm not going to sit there and keep playing a stock and not let the curiosity kill the cat, so to speak. I went finally and dug in and saw what they did, and I was like, well, damn, this stock is rather undervalued. So,
Got it.
and the same with Venue. Again, I am very impressed, but just the fact that you know Zach can sell a business to Mark Cuban and make a bunch of money off of it because Mark Cuban's not an idiot. He doesn't just go out and stupidly buy businesses. I'm certain he saw the potential and the value in the whole scenario. And Zach does a great job. Not only is he a damn good musician, but he does a great job in business too. I
Yeah.
mean, he's from my era. He's in his 50s, I think, isn't he? He's like
I think so,
55 or
yeah.
56, something like that.
Yeah,
I
there's
thought he,
So
I thought he was living in Florida, or no?
I guess so. I'm not sure. I just know that he's a well-known musician, and
Yeah,
I mean he's applied what he took from the music industry as a performer and recognizes everything that he's trying to do. He knows why he's trying to do what he's trying to do now with Venue, and
right.
and I believe all that stuff's going to end up being a big success for him. I really do.
Yeah,
Um,
well,
certainly hope so for the
here.
people in our group too.
Okay. Oh no, yeah,
absolutely.
I agree. Vino actually has a fundamental story as well beyond just having the technicals line up. But I guess one thing that, like you're talking about with Vinu Sheep earlier, is just the way the OTC is right now. It's just people are not trading it properly. They're kind of just in and out. They're hitting,
Yep.
quitting, and it's
That's
hard
called
to
a hit it or
see
forget
growth.
it.
Yeah,
I just hope it doesn't mean dilation is going to happen because eventually the company's going to have to raise money and at a
Well, I
lower
mean, a lot of
stock
those
price.
have had to dilute up to this point already. They've been diluting for the last year or two because of what's been going on with the bear market. It's when you can't get enough money to come in and get interested in your stock price and drive it back up to the levels of true valuation or even better, then I mean you only have one option to pay your bills. You know what I mean? And
yeah,
you can't necessarily look at dilution as always a terrible thing. These companies rely on it, to get them through the hard times when they're here. But again, when they thrive on the good times, I've seen several of those companies that had to dilute out at one moment, go back and start doing stock buybacks and things after everything turned around the other direction. You know what I'm saying? So not
yeah,
all dilution has been is a bad thing. There are those CEOs out there though that we talked about earlier that RS and then raise the AS, RS, then raise the AS and dilute it out. That's just it's a practice like they do, and they'll ride that game for a couple of years till they get busted at it and they close up. And that's usually why what they call them shell risks. You know what I'm saying? You got
mm,
to really kind of watch out for the shell risks that are out there, especially since all the new OTC laws have gone into effect and everything.
right.
So,
Well,
but yeah, the OTC still got great potential. I believe that there's poppers every single day, and if you go in there and do a scan on price range and everything for stocks, and I mean I literally have done my homework and I blistered through about 3,400 stocks the other day just doing my quick references and then honing down to like 600, 700, and then honing down to 150, and then honing them down to 35 or 40, and then hone them down again down to what I've got,
yeah,
a handful. And I like the handful that I've come up with. I really think that they've got real potential to do some major returns, 1,000 to 1,500% possibly in the end.
yeah,
So
definitely takes a lot more work than it used to. Looking at
yeah,
3,400 stocks as opposed to pick a couple hundred and half of them are probably going to go up. But
Well, you got to remember, I don't know. These new traders understand that if you don't do your homework, you're going to be left behind.
right,
It's one of those things where it's dynamic and it always is changing, and you've got to stay on top of what's going on with that so that you don't get left in the dust. And become a bag holder, because that's the biggest. That's the big term of the OTC is I'm a bag holder.
yeah,
So
definitely
and
been
I've
there
been a bag
before.
holder. We're all
Yeah,
guilty of it. I've been there.
Oh yeah.
The best advice I can give people about the OTC is a couple things. One is there is no such thing as hopes and dreams in the stock market. Never forget that. The second thing is don't marry any stock in the OTC at all. Don't trust the fact that they're going to go to $1, and don't sit there and set yourself up for failure. Use your risk management accordingly. That's the best advice I can give anybody for the OTC, because it's the escape from New York or the stock market, bud.
yeah,
It really is. And I just know that you with patience, and when the bottoms are around among you, which is what we've been in a bear market, and even the OTC has been stricken hard by a bear market. What do you do when it's getting close to the bottom of the bear market, especially in the OTC? You buy the pond scum and you cross your fingers.
yeah.
Always. That's what I do. Because they're going to move back up. It's just a process and a cycle. I'll tell you right now. Just between you and me, the fence post, and the rest of Twitter, I guess. PCLI has an incredibly good share structure, and the CEO apparently holds all the notes for all the debt for the company, and there's no threat of liquidation now, or cashing in from it or anything right now. They are building neighborhoods in Idaho. They're active, and it's a matter of time before they put out a PR that they've got, a bunch of house sales and stuff done. So I fully expect PCLI to perform at some point in the future here. I don't want to say, a month from now, but it could be 4 to 6 months before we see this thing really take off. But if you look in history, which is a history of no reverse split, they went to 0075 pretty quick. So off the bottom where it's at right now.
Definitely have to check that out. Well, Silly Sheep, it's been an absolute pleasure having you on for the second time on the show.
Well, I appreciate you having me.
Yeah,
And
and some good words of wisdom, right? Don't be a bag holder.
that's right. Don't be a bag holder, and use good judgment with this whole thing and risk management, because again, a bear market is absolutely it's just so much more vicious than a bull market. It's so much more dangerous for your capital than a bull market. Of course, you might miss plays on a bull market and wish you'd gotten into them before it took off. But with a bear market, you sit there going, "Oh my God, I wish I'd cashed out before that just happened to me." So use prudency when it comes to your risk management, and don't marry any of these things right now. Play the technical squeezes. If any questions at all whatsoever, anybody can direct message me on Twitter and ask me questions. If I know what it is, I'll answer the question. I'm not a professional. I don't charge for any advice that I give. I never will charge for any advice that I give. They're all opinions of my own that I've derived from the last several years of doing this, from my experiences and watching what's happened to others. So feel free to contact me if you have any questions.
Great.
Awesome, Sheep. Appreciate the words of wisdom again. We're all going to nut up, I believe, now, Luke. That's the new term we're going to start using when we
There
trade.
you go.
Yep.
You got
Well,
to just take that risk.
I'm excited for the next bull market. It might be another who knows how many years, but when it comes, we'll be ready for it. So
Yep. Take your squeeze money that you make and throw it in the bottom of the pond down there in the OTC. You'll be
there
happy.
we go.
Oh,
That's
yeah.
the strategy.
On that note, have a good night, everybody. Thanks
Thank
again.
you, sir. Thanks for coming on. Appreciate it.
Thank you, guys. I appreciate it.
All right. Take care.